All right, hopefully you can hear me. Checking a couple settings here. Excellent. All right. This is Dusty. I am one of the educators at Straight Talk Commercial Real Estate Academy. We do office hours every single Friday. And on the first Friday of the month, what we've been doing is broadcasting out not just to our members, but to a couple different locations, YouTube, a couple places on Facebook and elsewhere. So if you're seeing this somewhere other than the private members only group, welcome. What we usually do is I pick a topic. Now, actually, I forgot to update this. We're not going to talk about business development today. What was requested last time was that we talk a little bit about the basic commercial calculations that you usually see with commercial real estate. So this could be like cap rates, net income, stuff like that, gross rent multiplier, just some of the basic topics that we have covered before, but we're going to go into some detail on those. And then usually what we'll do is we'll do a topic like that. And if you have a comment, a question, anything while we're doing that, type it into the chat. If you're watching this after the fact, feel free to type it into the comments wherever you're seeing this. If this is out there on YouTube, go ahead and type the comment if you have a question. If you're with our private group, type it there as well. And then we'll answer it. So the whole point of office hours is to do training, but also a big part of that is going to be answering questions. So we're going to go ahead and do a quick topic today. And if there's no questions at the end of the topic, usually it's a 5 or 10 minute kind of discussion, then we're just going to shut it down. We'll see you next week. But if there are questions, we really encourage those. It doesn't have to be on the topic that we're discussing. It can be on anything at all. So today we're going to talk about the calculations that you typically see with commercial real estate. So this could be the net income. This could be cap rate, gross rent multiplier. Return on equity is a bit of a more complicated one, but we can talk about that as well. So we're going to quickly kind of go through the calculations for each of these. And if you have something that you want to discuss on top of that, if there's another calculation that you want to look at, go ahead and let me know, and we will discuss it as well. So let me just pop over here. There we go. So talking about net income, cap rate, gross rent multiplier, return on equity. So let's start with net income. The net income is the income that you would receive after the expenses. Now, these are operational expenses. So this would be essentially like this. So income so we'll say collected income, because there could be tenants that are not paying, or you could have some vacancies. So this is the income collected. All right, not the scheduled income. So you have what's called a scheduled gross income. Let's type that as well. Okay, so scheduled gross income is if everything was perfect, everyone paid on time, there was no vacancy, this is the maximum amount of rent I could receive over the course of a year. That's a scheduled gross income. Gross collected income is going to be what I actually collected. So did I have a vacancy? Did some people not pay? This is called credit loss or vacancy. And you'll see that on your income and expense reports. You'll see a line item that's called vacancy credit loss. And this is stuff that you did not collect because there was vacancy or because they didn't pay. So what we're looking at when we're talking about net income is the income that's collected. So gross collected income minus the expenses, operational expenses. Okay. So operational expenses are things that I have throughout the year that are going to be consistent. These could be fixed costs. Fixed expenses, right? Taxes and insurance, these are fixed expenses. These are the same, pretty much the same every year, right? Right? So you have fixed expenses, other expenses. I'm not trying to make this complicated, but you need to realize that there's not just expenses, right? So there's operational expenses that include both fixed and other operational expenses. These could be repairs, maintenance, utilities. These are going to fluctuate throughout the year, okay? And year by year, they're going to change. Your fixed expenses are one, other expenses and operational expenses are another. So when I say operational expenses, I mean the things that occur annually to operate the building. These do not include capital expenses, okay? So another term, capital expenses are not included in this calculation. A capital expense is a one-time expenditure or a very seldom expenditure that is not an annual expense. This doesn't happen every single year. I don't seal and stripe the parking lot every single year, for example. I don't replace the roof of a building every single year. But that could be a big ticket expense that I have that is part of my profit and loss, but it's in a different line item. Okay, so you've got your collected income that is after, obviously your vacancy and your credit loss. Then you have your operational expenses, which are the things that I do every single year. So these are my utilities, my taxes, my insurance, my management, my maintenance, utilities, and repairs. These are occurring every single year. They're fairly consistent. Usually what you'll find on multifamily, for example, is the operational expenses are about 36 to 42% of the gross scheduled income, not the collected income. And we can talk about that later. But I am going to remove, if I'm talking about net income, I'm going to remove my capital expenses. I'm not going to count the $15,000 roof replacement that I did that year. I'm going to remove that from my P&L because every dollar that I put into this, as far as net income goes, is going to improve my value. And you'll see what that is. So very basically, the gross collected income minus my operational expenses is my net income. Okay. That is what net income means. Now, let's move on to, we talked about net income. Let's talk about cap rate. Capitalization rate, very simply, is the annual return that you would get on a property if you were to have paid cash for it. So it's a percentage return on your money. So if I make $100,000 in net income, right? We talked about net income. And my price or my investment was, let's say, $1 million. In this market, it's a very good return here. My net income is 10% of my purchase price, right? So $100,000 is 10% of 1 million. My capitalization rate or my cap rate is 10% because I'm making 10% of my purchase price, or the price of the property, every year. This doesn't take into account debt, right? That would be your cash on cash return, right? So if I might get 100,000 net income on $1 million property, but let's say, let's go ahead and do this. Let's talk about cash on cash return, right? And again, if you've got a comment later, if you're watching this after the fact, comment below, ask whatever question you like. That's why we're here. So a cash on cash return would be, so we said, look, we're making $100,000 in net income, but that doesn't take into account the debt service. So I've got, let's say, for just to keep it simple, I've got 200,000, right, on my $1 million building. I've got a $200,000 down payment on my $1 million building. So I've got $200,000 that controls $1 million of value. My debt service on the property is, let's just keep it simple, is $20,000. So I've got that $100,000 in net income on this example property, but I've only got a $200,000 down payment. I've got $20,000 in addition to that being paid in debt service. So of the $100,000, I get to keep $80,000. Hopefully that makes sense, because we're using the same example. We're saying we have $100,000 in net income. Oh, go. Too many screens going on. And then 80,000 in cash flow. So the $80,000 that we have in cash flow is a return, or this is our cash flow. So this is a return on our down payment. This is not return on the total value of the property. We're getting a cash flow based on our down payment. And our down payment is $200,000. So if we divided this $80,000 right, or down payment, cash flow divided by the cash into the deal. So the cash flow is after debt service, right? Cash on cash return. This is my cash return based on the cash I have in the deal. So 80,000 divided by 200,000. This is a ridiculous example, but for the sake of argument, I'm getting a 40% return on this crazy deal, right? It's probably way different than that. But typically what you'll find is your cash flow is especially now with the lower interest rates, your cap rate's going to outperform your cash flow, or your cap rate's going to outperform your debt service, which is going to give you an increase to your cash flow and your cash on cash return. So if you're, let's talk about cap rate. Yeah, we talked about cap rate. So if our cap rate is, in this example, 10%, right? And our debt that we have on the property, this is a way crazy example, but if our debt was at a 5%, right? So if we have the $800,000 that we have to purchase this property, we have an $800,000 loan. If that's at 5%, we're getting the delta, right? 5% on the debt that we're servicing, and there's an extra 5% coming in for the cap rate. So we've probably got an increase. So if our cap rate is 10%, but the debt is different, is a differential of 5%, we're probably getting more than 10% on the return in this example. But as far as cash on cash return, that's how that works. Cash flow divided by the cash into the deal is your cash on cash return. Return on equity would be this calculation, but also the additional equity that you received at closing divided into the amount of years you have on the deal. Let's talk about that. And I don't see any questions, but if you have a question, ask it now or ask it after the fact. We're going to talk about return on equity, and I think that will wrap this up. Return on equity. I have a property that I am invested into. And I see this a lot. I've got someone who has a property who they bought, they bought it for $1 million. Like 5 years ago, right? And they're getting that $100,000 in a wise net income, right? So in their mind, this is a 10% return, okay? The actual value of the property is what they're getting a return on. So they're not getting a return on what they bought it for. They're getting a return on their equity, their current equity position, because all things being considered or being equal, you could redeploy that equity into something else. So if the property is worth $5 million, what is my return on it? What's my equity getting me? Is it getting me 10%, which is what I purchased it for? When I have a $5 million value? Because What I could do is I could sell it for $5 million. I could redeploy that money, and what would happen? Would I get a higher return? So my question is, what is my return on my equity right now? If I've got $100,000 and the value of the property is $5 million, I'm getting a 2% return on my equity. Okay, so a lot of owners will think, hey, I bought it for $1 million, I'm getting 100,000, I'm getting a 10% return. You are not. You're not. The property's worth $5 million, you're getting a 2% return on the equity that you have right now. Let's redeploy that, because $5 million, I can easily, with my niche, get you a 5% return. I could easily turn your $100,000 into $250,000 a year. Okay, hopefully that makes sense. But that's a return on equity. Hopefully that answers the questions. We also talked about gross rent multiplier. So gross rent multiplier. Let's chat about that. Still don't see any questions. So after this, we will shut this down and we'll see you next week. Gross rent multiplier. So my gross rents are, let's use the same number, just sorry to confuse it. So you could use gross scheduled rent. You could gross rent collected. That's kind of a gray area. Let's use the same value of the building. It's a $1 million building. Okay. Gross rent multiplier is very simply the number of times the gross rent goes into, or could go into, the property's price or value, or whatever you're considering. So if it's $1 million property, it's $1 million property, I'm collecting $100,000. $100,000 goes into $1 million 10 times. It's a 10 times gross rent multiplier. If you multiply $100,000 by 10, you equal the property's value. Gross rent. Right. Gross rent by the multiplier equals the value. So if I times 100,000 by 10, I get the $1 million value. And if you know math, you could switch and swap these things back and forth to find out the third value. So if with this on the cap rate, everything, if you find out two of the values, you can find the third by moving things around. So that's gross rent multiplier, that's return on equity, that's on cash return, and that is cap rate. Hopefully this has helped. Again, if you're watching this somewhere other than our private members only area, I invite you to join us. If you go to straighttalkacademy.com, let's go ahead and put the banner up. You can go ahead and sign up. It's a monthly fee of about $100 right now. You get access to about 50 hours of training in different classes. You have live training with us, obviously just every Friday. And then you can ask questions with our private group as well if you have any questions. So this is hopefully going to help you train. We go through everything from introduction to commercial real estate, to multifamily, to retail, to office, to marketing, everything you would need to know for commercial real estate. I invite you, if you're watching this after the fact, feel free to leave some comments or some questions. That's going to be it for me. There we go. We will see you next week.